Hi everyone, this is AO Accounting Academy. Today I'll be talking about IFRS 2, IFRS 2 share-based payment. This standard was issued in 2004, February 2004, but came into effect I think in January 2005. So the objective of this standard is to identify how to report, financial reporting for share-based payment transactions. There are some organizations that do give share options to the employees for services rendered over a period of time, or the in form of an entity deliver goods to the organization, but in exchange for those goods, the company can decide to issue share options to that vendor or whoever. Maybe it can be director of the organization, that those options can be exercised at a particular period of time. So this standard covers those share-based payment transactions and can be in two different forms. As you can see, it can be cash settled transaction or can be equity settled. Cash settled transactions occur when the party that deliver the goods or render the service has agreed to receive cash, but that cash to be received will be based on the value of equity instruments. That is what they call cash settled. So it can be in the form of cash or other assets, but that has to be in the value of equity instruments. So that is what they call cash settled share-based payment transaction. The equity based is when the party agrees to receive equity shares or share option in exchange for the services or goods rendered. So those are the two areas to look out for. So there's also what we call vesting condition. Is a condition that is required to be met to be able to exercise the rights, like the dates, or we call it vesting period. Vesting period in form of say the organization gives an option to exercise the share option for an employee, maybe after 2 years or after 3 years. That 3 years is what we call vesting period. So the grant date, on the other hand, is the date at which both parties agree for that transaction to occur. So that grant date is really important, especially when we talk about equity settled share-based payment. So I will explain that in detail when we get to that area. So to recognize equity settled share-based payment, it is expected that at the point of agreeing or making that arrangement, there will be some value or a value attached to the goods that has been delivered, if it's goods or services rendered, and those value is expected to be the fair value of the goods or services. So those value is what is used to recognize the liability and the expense or asset to be recognized in the books. But in the absence of that value, the standard says that we should use the fair value of equity instruments at the grant date. So there are two things. The first one is to look at goods or service delivered. What is the value of that goods or services delivered? So we use that value to determine the fair value of the liability to be recognized in the books, or the equity reserve to be recognized in the books. But in the absence of that value, if it's not easy to determine, like for an employee to have received a service, to have delivered the service to the organization for a period of time, to exercise such option, and in most cases we have to use the fair value of the equity instrument that the company is willing to give to the employee. So we call it value of equity instrument at the grant date. That's when the agreement has been made. So in the vesting conditions under the equity settled share payment, for equity settled share payment, there are two things to look out for that vesting condition. If there's a vesting condition, say 2 years or 3 years, it means that the liability will be gradual. So what that means is that you recognize at every point in time, let's say 3 years. For the first year, you debit your assets or liability. That's what I have it. Asset or expense, as the case may be, for the value for 1 year, and you credit equity instrument or equity reserve. Let me say equity option or share option reserve, as the case may be. So that value will be credited to that account over a period of 3 years. But if there is no vesting condition, that is no vesting period was mentioned, it means that we have to recognize that asset or expense in full from day one, which is at the grant date. So that's a condition. If there's a vesting condition, we need to look at the vesting condition of years, in terms of 2 years, 3 years, 5 years, depending on what the arrangement says. But if there's no vesting condition, it means that value has to be recognized in full at once. So that's the difference. Then there's also a note. There's a caveat from the standard. It says that once the vesting date has passed, no further adjustment should be made to equity after the vesting date has passed. So that needs to be that can happen in the instance of say maybe the option has not been fully exercised at the vesting date. So even if that happens, the standard says that no further adjustment should be made to equity. So that's what we need to know. So let me now start looking at those areas, those questions I have here. I have a scenario here, so let's just look at it. It's a very simple scenario. So the question says, like I used to do, I'll put solution here. So the question says, on January 1, 2024, ABC Limited grants 1,000 stock options to its employees. On January 1, look at the date here. ABC, the date is really important here. ABC Limited grants 1,000 stock options to employees. The options will vest after 3 years of service. So there's a vesting period of 3 years. Yeah, so let's look at it. Vesting period equals to what? 3 years. 3 years. Meaning the employees must work for 3 years before they can exercise the option. So the fair value of each option is estimated at £5 on the grant date. So at the grant date, what is the fair value? Fair value of option at grant date. If there's any fair value at any other date, we will not use it. We have to use fair value of option at grant date, which is what? Which is £5. Yes, this is the fair value. So what is the total number of options? Stock options. So stock options is in total of 1,000 stocks. So this one is in value of GBP. This. So now we need to now calculate what the expense, the share based expense will be, and also what the liability will be. So to do that, let me insert more. So we now say that fair value of total option will now be this 1,000 number of options times 5. So it's 5,000. That is in pounds. format this currency in pounds. So that's 5,000. So, but this 5,000, don't forget I said that because the vesting period is 3 years. So this 5,000 pounds is actually for the whole of the 3 years. But because there's a vesting period of 3 years, so we cannot recognize that amount in full. So we need to now break it down into 3. So what we need to do from in our journal will now be, sorry, I had to do this again. Will now be, let's say 31 December 2024. That's the first year, because the first period is 1st of January. So we assume the first year is that. Then divide by 3. So that value, we now say that this value now, our journal will now be debit share option expense, because an expense to the organization of that value, and credit because it's stock option, so we now say stock option reserve. So this sits within the equity in the balance sheet. That's for year 1. For year 2, the same thing will happen. Let's say this is 31 December 2025. Do the same. Say debit share option expense of that amount, again the same amount, and the liability will be the same. So what happened is that that amount of liability will continue to grow. I mean, our share option reserve be year 1, year 2, year 3. So year 1 will be that value. Year 2 will be cumulative. So the value will continue to grow, and year 3 will be whatever we calculate for year 3. So that we arrive at that 5,000. So don't let us waste too much time on that. But that option has to be exercised at the grant date, and the value that we record will be the value for 1 year transaction. So let me now go further and look at another scenario. The second scenario says this. So let me put a solution here. So the second scenario says on January 1, 2024, DEF Limited grant 800 share options to employees. This is contingent on achieving a certain sales target by December 31, 2026. So look at the date here. We need to achieve a target by 31st of January 2026. 2026, that's 2024, 25, 26. That's 3 years vesting period. So vesting period here is also 3 years. It's also 3 years. Options is 800, right? And the fair value of each option on the grant date is £4. So fair value of option at grant date is £4 GBP. at the end of 2024, DEF estimates, that is, by the time the company wants to recognize it in the books, discover that the company estimates that 70% is 70% probability of achieving the target. That is, those employees who achieve that target, it is estimated that it is 70% accurate, or 70% probability that that target will be achieved. So the way to exercise this option, the way to pose this transaction, is to show that, okay, what is our probability? Probability is 70%, right? It can be any percent. That's 70%. So for us to do that, we say the value to recognize will be value of total option will be 70% of the 800 times, what is the value? £4. So this £4 will be this 2,240. Let me change the up here. Format printer. Come down here. So that 2,240 is the total value for 3 years. So the same thing that we did earlier, we have to do it. Let's say 31 December 2024. So the value will now be this divided by 3. So this 746.67 is that amount that will be recognized each year till at the end of the option. So let's now look at the third one. So the third one is like a modification. So, and I want us to be really attentive here. So because this one is different, the way to post that transaction is totally different. So the question says, on January 1, 2023, GHI Limited grants 500 share options to employees with a fair value of £5 per option and a 3-year vesting period. In 2024, the company modifies. Can you see there's a modification here? There's what we call modification in share option. So it's possible that the company modifies that option to maybe reduce or increase the exercise price, to increase the fair value. So but this question says the company modifies the terms by reducing the exercise price, which increases the fair value of each option to £7. So what do we do here? What we need to do here is looking at the option here. So solution, like we used to do, we have vesting period. Vesting period is what we need to first of all to do. What is our vesting period? Is 3 years, yeah? 3 years. Fair value of option. Fair value of option is £5. That is really important at the grant date. That is the fair value at the grant date. So we need to know that for sure is at the grant date. So in 2024, the company modifies. That is by the end. Let's say this is 2023. Let's say December 31, 2023. The value will now be, because it's 500 option, it will be 500 times, what is the fair value? This is 2,500. If you look at it very well, we have 3 years to amortize, to to allocate this to each of those period. So what we'll do for the first year is that we'll need to post our debit share option expense, share option expense of £2,500 divided by 3. That is 833. So that 833 is the initial amount for the first year. But we cannot do the same for 2024 because the company modifies the term by reducing the exercise price and increasing the fair value of each option. So what is the increase in fair value? Increase in fair value. Increase in fair value is, there's a let me say the new fair value. Let me just write at 2024 fair value of option has increased to £7 as against £5. So the increase will now be 7 minus 5. So because the total options available is still 500, you now say incremental value of option. That's what we'll say. Incremental value of option will now be 500 times the increase. That is 1000. But don't forget that we have 3 years. That is the technicality here. We have 3 years to that option. So that 3 years to that option, it means that as at this date, I mean as at 2024, because 2023 has gone, it means we have only 2 years, 2024 and 2025. So it means this value of increment will apply to only 2 years. So we now say that for year 2, after debiting share option expense of, because the first year we debited 833, I didn't credit, but because, let me just put the credit there so that I will not forget. The credit is share option reserve that sits within the equity. So it's the same thing here. So after doing this one for year, this is year 1. Let me put the year here, X year, year 1. X year 2. We now need to add, okay, let me complete this one. We now need to add the increment. So that also goes to share option expense, and that one is what? £500, which is this one divided by 2. So then you credit the same amount. So the total to credit in that year will increase, will be a total of 1333.33. So the same thing for year 3. So let's now look at cash settled share option scheme. Cash settled share option scheme is totally different, and in fact I would say is much more complicated than than the equity settled, because equity settled is straightforward. We need to look at the grant date, we need to look at the vesting period, and also look at the fair value at the grant date, which is really key. Or if there's no fair value, or if there's a value to the services received or goods delivered, then we can use that value. So that one is pretty straightforward. But for cash settled share-based payments, we need to use what we call option pricing model. That option pricing model, for the purpose of this lecture, I won't be delving so much into it, but I'll make another separate video to explain. But let me just give a little. I think there are three basic methods that the standard permits. There's what we call Blasco's model. That Blasco's model is used for European style option. That's the option that can be exercised at the expiration of the vesting period. There's also what we call American style option. That American style option we use binomial model. So that option can be exercised at any point in time, and also the standards also permit Monte Carlo simulation. So but for the purpose of this, I won't be going deep into it, so we'll only look at the scenario that we've got. And one thing that is also key here is that the standard permits that we remeasure the fair value of liability that is sitting in the books of the company at each reporting date until all the options have been fully settled. If it's not fully settled, like I was saying, so let's now look at the scenario that we have here to work on the cash settled share-based payment. So I won't be talking about option pricing model, so I'll do another separate video for that. So let's look at this. The question says, on January 1, 2024, XYZ Limited grant share appreciation rights to employees, allowing them to receive cash based on the increase in the company share price. This is share appreciation rights. So the SAS, which is share appreciation right, vests after 2 years. The vesting period here. So let's do the same thing. It's simple. Anyhow you see the question, I think the vesting period is one of the most important thing that you need to first of all point out, because if you don't get that vesting period right, you won't get the answer right. So the vesting period is 2 years, and employees will receive the cash equivalent of the increase in the share price. So it's not the share price, the cash equivalent of the increase in share price. So we need to know that. That is really important. So on January 1, 2024, the share price is £10, and the fair value of each share appreciation right is £3. So which one should we use? So look at it very well. So this is the share price, but this is the value of the share appreciation right. So the value of share appreciation rights is what is important to us here, and total options which is SAS options. Let me use that word, SAS. Is 500. So for year 1, the vesting period is 2 years. So for year 1, we have the total value is 500 times 3. That's 1,500, and we have 2 years to vest it. So debit share. Sorry. Debits say expense to the employee divided by 2. That is it. Then credit liability. So this one is different from the one that we discussed earlier on, which is equity based. This one is cash based, because the question says allowing them to receive cash based on the increase. So this is what is to be received. Cash is to be received, but it's based on the share price. So what we are crediting here is not the equity, it's just the liability. So let's get that right. So that's for year 1. For year 2 it will be the same thing. But let's now assuming I want to put something to this question. Assuming that say, okay, fair value of SaaS increased, let's say increased to maybe, let me say £5 at in 2025. This is 2024. So before the end of the 2 years, so let's say the fair value of the SaaS increased to £5. So what we need to now do there is, we now say that value of option or SaaS, let me see, will now be 500, the same 500 times, this is 5. If you see it, you see that this one is 5. It has increased from £3 to £5. So we'll now put the £5. So the total value will now be 2,500. So what that means is that what should be sitting in the books is 2,500, no more 1,500 that you have here. But because if you look at from year 1, we already charge 750 to liability. So what we now do is we now say first year liability. How much is it? What we charge to liability is this 750. So we now say what is the balance that will be sitting in the that will be posted in year 2. So it means in year 2 what you do is you debit expense of 750 and you credit liability for 750. So all in pounds, everything in pounds. Let me format this. Currency pounds. So this is what to be posted in year 2. But if this happens, because it happens in year 2, let's now assume that the vesting period is 3 years. It means in 2026 it's supposed to continue to 2026. It means that this value will be split into 2025 and 2026. So not one will be posted once. We need to recognize value at each of those vesting period. So thank you so much. This has been really insightful. For more videos on option price model, I'll do different video on that so that you can understand how we do our option pricing. If you think this video has been really beneficial to you, please like and subscribe. Thank you so much for watching AO Accounting Academy. Thank you. Bye.